Welcome to Coin Pulse, your go-to channel for everything money. From crypto insights and stock trends to the jaw-dropping financial stories of the rich and famous. Stay informed, stay successful, let's talk money. The market is getting bumpier, and easy gains in tech are fading. But not all hope is lost. Some stocks are still thriving. In this video, we'll uncover 6 unstoppable tech giants poised to dominate 2025. Let's dive in. Gains with tech stocks are no longer as easy as in 2024. But not without exceptions. We reveal why 6 stocks are unstoppable. The game was a hit at kids' birthday parties. Musical chairs. As long as music played, the boisterous crowd circled a group of chairs. Always one fewer than the number of players. When the music stopped, everyone scrambled to sit. Whoever was left standing was out. Chance for a once-in-a-century boom. Stock market observers are reminded of this childhood game. Applied to today's market activities, this means, except for the COVID era, the music has been playing since 2009, with investors running around the chairs and driving prices higher. In the tech sector, market sentiment has been particularly euphoric. AI beneficiaries like Nvidia have multiplied in value. The Magnificent Seven have become the symbol of a once-in-a-century boom. But the fact remains, at some point the music will stop. Anyone who doesn't react in time will lose. Nervousness is growing. Pundits warn that U.S. stocks have become dangerously expensive compared to historical averages. The bond market is also causing headaches. U.S. interest rates threaten to fall more slowly than the market has priced in. The U.S. dollar is flexing its muscles, making life difficult for U.S. companies reliant on exports. And President Donald Trump threatens higher tariffs, deportations, and territorial claims on Canada, the Panama Canal, and Greenland. In other words, uncertainty on the trading floor is increasing. The S&P 500 index is finding it harder to sustain the highs of recent weeks. Measured by the median, more than 1/5 of stocks are 20% below their record levels. Even high-flyer Nvidia has recently lacked momentum. The question remains: sit down or keep running? Cash in or buy more? Secure profits or take risks? Wonderful opportunities. Stock trader Peter Tuchman, dubbed the Einstein of Wall Street for his resemblance to the genius, remains optimistic after the strong 2024 market. Throughout the year, we only had 7 waves of selling, and each one was nothing more than a wonderful buying opportunity, says the New York floor trader enthusiastically. It's likely that investors will soon have another chance to buy. The reason lies in the advanced decline line, which measures the ratio of advancing to declining stocks. Although the NASDAQ 100 Technology Index gained over the past year, the AD line fell during the same period. The explanation from chart analysts: fewer and fewer stocks are participating in the rally. For experts, this isn't a cause for panic, but the financial experts acknowledges that the risk of a correction is rising. Nevertheless, their positive outlook for 2025 remains unchanged. The high valuation of many high-tech stocks, the experts argue, is not without reason. For instance, chip leader Nvidia raised its operating margin to over 60% within 2 years. The profit growth of the Magnificent Seven is expected to reach about 28% in 2024. By comparison, the broader market achieves around 4%. Charman Masivar Ramani, chief investment strategist at Goldman Sachs, also dismisses the notion of a stock market bubble. There's no statistical evidence that stock valuations must revert to a mean, she emphasizes. High valuations alone are not a reason to exit the stock market. Headwinds from the bond market are a different story. Long-term U.S. Treasury yields have risen almost daily recently, despite the Federal Reserve cutting rates 3 times since September. 10-year Treasuries are currently yielding nearly 4.8%, the highest level since last April. By comparison, in mid-September, the yield was below 3.6%. Headwinds expected. The problem is that rising U.S. rates, long seen as a harbinger of economic growth and higher corporate profits, are now perceived as a risk factor. Specifically, Trump's proposed economic policies of higher tariffs and tax cuts are stoking domestic inflation, potentially forcing the Fed to end its rate-cutting cycle unexpectedly early. This would be disastrous, especially for young tech firms. Aside from making loans costlier than expected, their future earnings discount rate, and thus their stock prices, are highly sensitive to interest rates. Does this mean it's time to ditch tech stocks? The ongoing AI hype has intensified the arms race in the tech sector. The fear of falling behind in new applications has triggered an unprecedented investment boom among major data center operators. Together, Microsoft, Alphabet, Amazon, and Meta alone are expected to have spent over $250 billion in 2024, nearly $40 billion more than the previous year. Microsoft has already announced plans to invest another $80 billion in data centers this year. As much as the combined capital expenditures of the five energy giants, ExxonMobil, Chevron, Shell, BP, and Total Energies in 2024. Despite the growing uncertainties in the market, one thing remains certain: there are always winners. Even in a turbulent environment, some companies continue to benefit from transformative trends like artificial intelligence, cloud computing, and automation, with growth potential that shows no signs of slowing down. So, which companies stand out as the exceptions? We identified 6 tech giants that are set to keep rising in 2025. Here's why these stocks are worth your attention. 1. Amazon. Powerhouse with AI, kick the company. The world's largest online retailer promises to deliver any product to any location, and delivers on this promise. As a result, the former bookseller is valued at $2.3 trillion. Notably, 73% of its quarterly revenue comes from North America, a key factor in light of the strong dollar. The numbers. Amazon is brimming with strength. Revenue in Q3 grew by 11% to nearly $159 billion, about $1.6 billion more than expected. Cash flow surged by a staggering 123%. The largest growth driver is the cloud segment, AWS, which grew by 19% to $27.5 billion. The story. 3 reasons to bet on the stock. AI, AI, and AI. This technology enables higher margins through efficiency, automation, and growth in advertising. Long-term cloud growth fueled by strong demand for optimized workflows. Improved delivery services and product availability in retail. 2. Meta. Geared for returns, the company. Meta Platforms, formerly Facebook, is the world's largest social media company. With 4 core apps, Facebook, Instagram, Messenger, and WhatsApp, the online giant reached 3.3 billion monthly active users in Q3 2024, a 5% year-over-year increase. The numbers. Analysts expect strong growth in revenue and profit for 2024, projected at 21% and 52% respectively. Further growth of 15% in revenue and 12% in profit is anticipated for 2025. Drivers include the expansion of key apps, increased ad impressions, and higher ad prices. The story. Meta has a clear AI strategy. CEO Mark Zuckerberg focuses on efficiency, including cutting underperforming employees. With a high return on capital, the company is positioned for rapid growth. Analysts predict a TikTok ban could boost profit growth by up to 10%. 3. Nvidia. A once-in-a-century opportunity for investors. The company. Just 3 years ago, Nvidia was a relatively unknown graphics card supplier for video games. Today, it develops the most powerful computer chips for artificial intelligence. The numbers. Nvidia converts half of every revenue dollar into profit, an exceptional benchmark. Earnings per share surged to $0.799 in the latest quarter, up from $0.37 a year ago, while revenue nearly doubled. The story. Even as competitors, including in quantum computing, close the gap, Nvidia remains the nucleus of the AI revolution. Its new AI chip, Blackwell, is a cornerstone of AI infrastructure. Proprietary software is indispensable for AI developers, and its Cosmos platform bridges the digital and physical worlds, such as by training robots. Verdict. A once-in-a-century opportunity for investors. Qualcomm. Catch-up candidate with 30% upside. The company. Qualcomm is a global leader in mobile and 5G chip manufacturing. Industry experts see the Californian company as pivotal in developing next-generation internet technologies. The numbers. Management expects Q1 revenue of $10.9 billion, covering the US and European holiday seasons, with adjusted earnings per share of $2.95. Wall Street anticipated $10.6 billion and $2.86 per share. The story. Experts view the automotive technology business as highly promising due to increasing electrification. Additionally, Qualcomm is attempting to enter the personal computer market. The stock is attractively priced, with a 2025 price-to-earnings ratio of 17.5, a catch-up candidate with 30% upside potential. ServiceNow. Strong growth for long-term investors. The company. Service. Now's cloud-based solutions help large companies optimize workflows with digital tools. Users can scale operations more efficiently, reduce costs, and better integrate remote employees. The numbers. Average revenue growth of 22% is expected for 2024, with adjusted earnings projected to rise by 29%. Positive momentum is also forecast for 2025, with respective growth expectations of 21% and 19%. Automation in businesses is a key driver. The story. At 118 times the expected 2025 earnings, the stock isn't cheap, but quality comes at a price. Robust growth, a stable ecosystem, and a strong presence in the booming AI market make this a compelling long-term investment. 6. Uber. Undervalued stock. The company. Shares of U.S. ride-hailing and food delivery giant Uber have recently fallen out of favor, losing 1/5 of their value since October. The drop is attributed to growing concerns over self-driving robo-taxis from competitors like Tesla and Waymo. However, analysts believe Tesla is unlikely to meet its ambitious goals for the coming year. The numbers. Q3 results shattered expectations. Operating profit surged 169% to $1.1 billion, surpassing expectations of $976 million, while revenue climbed 20% to $11.2 billion. The story. Despite a 50% market share, excluding China, the stock is cheaper than rival Lyft and trades below its potential. Management is increasingly open to autonomous driving and is working on improving operational efficiency, which should boost margins. Even in uncertain times, tech leads the way. These 6 stocks show the power of innovation and growth. Ready to make your next move? Drop your thoughts in the comments and don't forget to like and subscribe for more insights. See you next time.